Hello everyone and welcome to our webinar ATO Insights on Draft Practical Compliance Guideline on Cross-Border Financing. I am Nehal and I will be your moderator today. Your presenter today is Shazheb Panhwar, Assistant Commissioner of the Australian Tax Office, and the session will be facilitated by Jerome Say, Partner at King & Wood Mallesons. Shazheb is an Assistant Commissioner in the Law, Advice and Resolution area within the Public Groups and International Business line of the ATO. Shaz has primary responsibility of related party financing as well as thin capitalization. Jerome advises clients on income tax law, including on anti-avoidance, diverted profits tax, taxable Australian property issues, transfer pricing, regulatory access regimes, and dispute litigation strategy. His portfolio includes clients in the banking, mining, oil and gas, and private equity industries. During today's webinar, you can submit questions via the Questions tab at any time throughout the webinar. If we are unable to answer your question during the course of the webinar, we will do so post-webinar. I think we are ready to begin, so I will hand it over to you, Shaz.
Thank you, Nehal, and welcome everyone. Thank you for attending. I know everyone's time is valuable, so hopefully this will be a very useful walkthrough about some recent guidance that the ATO has released in relation to related party financing. So the main, I suppose, thrust of this discussion will be in relation to the ATO's Practical Compliance Guide 2017/D4, which has the really catchy title of ATO Compliance Approach to Taxation Issues associated with cross-border related party financing arrangements and related transactions. But in short, it's the Practical Compliance Guide which the ATO has released, which provides some guidance in relation to cross-border related party financing arrangements. So now if we just move on to the overview slide. So hopefully today I just want to cover a few things to provide you with a bit of information and background about the PCG, about how you'll be able to use it, and some things to look out for. So we really want to cover through things like the history of the PCG. So what's the background, because I'm a big believer that the context as to why a document was brought in is very valuable to understanding its reasoning. What is a practical compliance guide and how does that differ from other ATO products? Some of the risk indicators that are currently within the Practical Compliance Guide, how the ATO will use this document and how the ATO will monitor taxpayer behaviour going forward. Some discussion about some transitional arrangements which the ATO has envisaged or allowed for within the document. Discussion, so the PCG had a feedback period closing on 30 June of, so a couple of weeks ago, so 30th of June, and really discussing some of the submissions and some of the feedback that we have. And then lastly, and I'll stress, I'm mindful that listening to me for an hour might be a bit of a task, so hopefully we'll break it up every couple of slides and I'll pause for a moment to see if there's any questions from the audience, and we'll hopefully have it a bit more interactive. So now just moving on to the next slide and the history of the PCG. So in order to understand the history of this Practical Compliance Guide, really need to go through the history of related party financing, especially within the ATO tax space. So historically, and I'm not talking about that long ago, probably 3 or 4 years ago, the entire discussion about related party financing from both an advisor and an administrator perspective was really surrounding two questions, or really revolved around two core questions. And that was, well, what is the credit rating of the entity? And secondly, what is the price that credit rating for that particular instrument or entity, what price would that instrument command in an open market? So it's really limited to, and really what happened was there was an acceptance that, well, everything about the taxpayer, the instrument that it's entered into, its profit and loss statement, balance sheet, everything about the arrangement was taken as a given, that those were fixed sort of constants in the analysis that you had to perform, and that really what you had to consider was, well, what do the outputs then tell you? What do the credit rating and the price tell you about this instrument? That's now sort of change. So that was I suppose, the realm of cross-border related party pricing for a long time. Four things, so I sort of put down four things, sort of gave taxpayers pause or need to reconsider these arrangements. The first was the work done globally by the OECD in their base erosion and profit shifting agenda, especially in relation to related party, so on financing generally, and the emphasis they put on financial transactions in their BEPS action items. Secondly, being within the ATO, there has been, especially the last few years and some of the recruitment we've had, a growing sophistication in the way that we understand, analyze, and execute financial transaction analyses. So we've certainly grown our capabilities within that space. So within my team alone, I have 3 people who are former members of banks or high-ranking people of banks who really have a lot of experience as to how financial institutions have or assess debt transactions. The third was the, I suppose, acting or the implementation of the Div 815 suite of legislation. So the first, the interim measures, which was subdivision 815A, and then the new transfer pricing provisions being subdivision 815BCD. So those 4 things really, so those 3 things really changed the landscape. And then the last thing is the Chevron decision, which hopefully most of you have heard about, but that really did give taxpayers pause. So that really sort of shed light on the fact that, you know what, maybe this historic analysis or this historic lens used to assess financial transaction with regard to transfer pricing, maybe that lens isn't quite broad enough, and maybe we just need to broaden it a bit wider and consider a few other factors and a few other relevant features of an arrangement in order to come up with a price for it. So that's the background context. And so all of those things happened. There was a internal working group in the ATO, so comprised of ATO members, advisors, industry representatives, industry body representatives, which was the Division 815 working group. Now that working group was really designed around, okay, there is the implementation or the, there was the enactment of new legislation. What do we need to do? What do we need to put in place to ensure that it's understood and it is, we have appropriate guidance and measures in place to ensure there is a minimal disruption. One of the things the 815 working group did is to list out the priorities of areas that they believed that the new legislation required further guidance on, so certain transactions or certain areas of the law that required further guidance. One of the key areas identified was in the suite of financing. And so the initial intention from that group was to create an interpretive product, so a tax ruling or tax determination about how the new transfer pricing rules would deal with financial transactions. Now, I was sort of selected as a key author of that document, so the initial intentions of this practical compliance guide was to be an interpretive product, and I think that's very important to remember that the intention was to be an interpretive product. Through the process of writing it, it was incredibly difficult for me to have a document which accurately reflected the law, but also provided enough guidance for taxpayers to be able to apply to their circumstances. And the difficulty is because financing is such a fact and circumstance dependent transaction or arrangement that it's very difficult to give the type of guidance that taxpayers may desire in order to, well, what are the key hotspots that the ATO is looking at. To give that within the context of an interpretive document such as a taxation ruling was incredibly difficult. So the document morphed into this practical compliance guide. Now, in coming up with the practical compliance guide, we used a variety of sources of information to come up with the indicators or the data that we use to support it. So through our review activities, we have spoken to numerous sort of bankers and corporate lenders. We've spoken to numerous treasurers, numerous, I suppose, employees or former employees of credit rating agencies and other sort of market participants that, their entire job has been around financing, the pricing of financing, the raising of debt in third-party markets. So we had a lot of information from there. We also obtained a lot of data from credit rating agencies about how subsidiaries and multinationals of multinationals and subsidiaries of those multinationals, how they were rated, and the data and the financial, I suppose, metrics that surrounded those subsidiaries and multinationals. So we knew, well, if there's a rated subsidiary, a rated multinational, what is, across an entire population, how are they structured in terms of their P&L, their capital structure, and certain financial metrics. So a lot of information was put in, and we selected what we thought were some key indicators which reflected, based on our experience, based on the data that we had, based on a regression analysis of all the financing transactions we've done. Here are some of the key indicators which, in our experience, would indicate a risk that there may be a transfer pricing adjustment. Right? So these are, and I'll stress that this document again is a risk-based document. It wasn't the interpreter. It isn't the interpreter document which was intended to initially be. It has now morphed into a risk-based document. So once we determined some of these criteria, we moved on to a period of closed consultation. So we shared our initial draft with 3 market participants. So the first was a corporate treasurer and tax manager of an ASX top 50 listed company. The second was a former member of one of the big 4 banks' credit lending committees, so someone who's very experienced analysing financial transactions and approving it from a banking perspective. And the third was a boutique US firm whose job it is to advise their clients as to how to actually raise debt in debt capital markets, so either public or private placements. So that was the period going. They provided feedback. That was a lot of that was incorporated and found its way into the current iteration of the draft which you see before us. So next slide, Nehal. At this moment, I think it's probably useful to just let the audience members know what exactly a practical compliance guide is and how it differs from some of the other products that you may be more used to the ATO issuing. So the main products which you may be used to are our interpretive products, which are taxation rulings or taxation determinations, so TRs and TDs, or you may be useful to some of our practice statements on law administration, so PSLAs. A practical compliance guide is a document, so to give a bit of context, taxation rulings are very useful, or they're used where the ATO wants to communicate how it would like to, or I suppose its views on how it will interpret a particular bit of legislation. So if there's an interpretive question out there as to how will the ATO interpret this particular provision, a taxation ruling is fantastic in communicating the ATO's position, the Commissioner's position with regards to that. Or elements or arrangements where the interpretation may be relatively clear, but the actual practical application as to how you derive an amount is unclear. Taxation rulings don't really help. So for example, if anything deals with the valuation, a taxation ruling generally cannot be used to communicate how we will treat valuation reports or what we will look at, because it's not really a legally interpretive. It's not a question of legal interpretation. It's more a practical question as to how will we administer the law. Where you have those type of questions, a practical compliance guide is incredibly useful. So they're new products the ATO has been using for probably the last 18 months or so, and they're really designed to communicate to taxpayers the practical approach the ATO will take in administering the law. Right? So it's really broader guidance which allows us to communicate how we will sensibly apply audit resources or provide some practical compliance solutions where tax laws are uncertain in their application or are found to be creating, I suppose, unsustainable administrative or compliance burdens. Right? So where you have these difficulties, practical compliance guidance are incredibly useful. They're really prepared in when these sort of issues arise or when they're required. So if there's a particular need to provide some sort of practical compliance or some guidance on a particular product, that's how they're sort of prepared. Again, I mentioned that they're not interpretive. So in the sense that they are not legally binding on either the Commission or the taxpayer, so they don't have that sort of force. The Commissioner does sort of stand by. Every single practical compliance guide will have a statement as to how a taxpayer will be able to rely on that particular guideline to provide additional comfort or how it can be used. So for example, this current practical compliance guide says that if you fall within a particular zone or your scoring falls within a particular zone, then you should be able to rely on to the extent that the ATO will not seek to dedicate resources to review your arrangement other than to make sure that you truly do fall within that zone. So next slide, Nehal, and I might just take a bit of a pause there to see if there are any questions coming through or if anyone would like any. Yep.
Yeah, Shaz, I guess I understand what you said on why the PCG was created and the difficulty with putting interpretive guidance out there when there are difficult issues like valuations. I guess I've got 2 points to start with. I think the first point is that you're right in saying there isn't a safe harbour within this PCG, and I think you say that specifically in the document. And I think it's important for everyone to realise that despite what's in the draft document, businesses still need to make sure that they comply with Division 815. They still need to prepare the TP documentation. This will help them assess risk, but they still need to comply with all the legislation and all the requirements.
Absolutely.
Yeah, and I think the second point, I've been hearing around the traps that there may be further guidance being issued on things like guarantee fees and loans and derivatives. Would that, if that's right, would that likely form an interpretive document, or do you think it'd be more a PCG that you'd be looking at again? Because I can see there are mixed questions of law and fact in those as well.
There certainly are. So on both of those points, so thank you for bringing that up. That's correct. So this PCG does not change a taxpayer's requirement to abide by the law, right? So the Commissioner cannot say that the law does or does not apply to your particular circumstances. All we can say is that based on our assessment of the risk, we will or will not apply resources to review your arrangement. So nothing in the document sort of alleviates any sort of requirements that the law has to self-assess your own tax positions. However, with a lot of tax, there's always a question of, well, what do we spend our resources on? Is there a sort of cost-benefit analysis? And I suppose what we're trying to do with this document is maybe help inform some of the cost-benefit analysis that a taxpayer may go through in what they throw resources on to support and to what degree do they put documentation together to support that. The second one, and I was going to get to that later, but you brought it up at the moment. So the intention at the moment is for further schedules of this current PCG to be issued in relation to issues like interest-free loans, guarantee fees, related party derivatives, and hopefully the arm's length debt test in the fullness of time. They will be schedules to this current PCG. So at the moment, the part on the related party financing is the main, I suppose, contentious part is contained within a particular schedule, Schedule 1 of this document. The other areas will form subsequent schedules of this entire document. If there is a need for a particular interpretive question, so for example, with the arm's length debt test, there may be a separate interpretive product released in conjunction with it. For interest-free loans, there will be a separate interpretive product released in conjunction with it. So there's, it really depends on the facts and circumstances of the issue as to whether we go just practical compliance or whether we package that up with interpretive as well.
Okay, thanks. That's helpful.
Thank you. So moving on to the next slide, which is to talk about some of the risk indicators.
Maybe back one slide. Yes, that one.
So overview of the risk indicators, is that where everyone's at?
Yeah.
Fantastic. So this practical compliance guide at the moment, Schedule 1 covers related party, cross-border related party funding arrangements for most of the population. It does carve out certain arrangements or certain entities where we felt that the status quo reality of these entities would mean that they were sort of artificially ranked high risk just because of their normal realities as opposed to any sort of tax planning or structuring going on with these arrangements. So there are certain entities that are carved out. I think it's important to know whether or not your business or your arrangements fall within those carve-outs. The PCG itself, as Schedule 1, really covers what I call four high-level risk areas. So the first thing to note is that when we're talking about risk, the risk that the ATO is required to assure is interest deductions, right? Total interest deductions. So what makes up interest reductions is two things. One is our first headline sort of risk area, which is obviously the pricing of those arrangements. So there are a number of indicators here which go towards questions regarding the pricing of the funding arrangement. And that's really the main risk that this PCG is sort of designed to cover. The second part of the interest reductions question is the quantum. And the question is, well, how does your arrangements tie in with regards to the ThinkCap safe harbor? So the further, if you're outside safe harbor in ThinkCap, then obviously, by definition, if you're not within the safe harbor, there's a little bit of lack of safety outside of that. So all we're sort of saying is until, and we will sort of issue further guidance about taxpayers who are using the arm's length debt test or other sort of ThinkCap mechanisms, but generally, if you're within safe harbor, there won't be too much risk. So those are the first two, so pricing and quantum relative to ThinkCap safe harbor. The third is commerciality. Now, we have concerns, especially when you're subsidiaries of foreign multinationals in Australia, where they may have transfer pricing policies which will provide returns at an EBIT level. So an operating margin or return on costs or whatever the particular metric might be, but a particular profitability relative at your EBIT level. Now, we have concerns where quite a number of arrangements involve financing arrangements which to us would seem very excessive, and to the extent where not only do they chew up all of that EBIT left over by the transfer pricing policy, but priced to such an extent that there was no foreseeable, there was no way foreseeably, or sort of reasonably foreseeable that that taxpayer would ever make a profit while those instruments were in place. So that is a risk that we also have a look at. Based on our experience, taxpayers who have those type of features are more likely to be, I suppose, aggressively challenging the transfer pricing rules, if I put it that way. The last sort of area, so that's the first three, the last area is the presence of tax structuring. So there are certain criteria or indicators which go towards an appetite of tax structuring. Now, based on our experience, taxpayers who demonstrate these indicators of tax structuring also are more likely to, I suppose, price aggressively or have aggressive positions in relation to transfer pricing and other provisions. And so again, where there are these indicators of tax structuring, that's also a risk that we want to capture and we want to deal with. The scoring zone, so each indicator either provides a qualitative or a range of quantitative positions and scores, and assigns a score depending on where you fall within that range, or whether it's a yes or a no, where you fall on that qualitative scale. Those scores then get aggregated to your total score, as it currently reads in the draft, and that total score then determines which zone or risk zone that you fall into. The zones are designed to, I suppose, communicate the likelihood of ATO review. So we have 6 zones overall. The first I want to talk. I'll talk about 5 at the moment. The first is the green zone, and the green zone indicates that based on your arrangement, if you score within that zone, that based on our experience, the risk of your arrangements is so low that the ATO will not seek to apply compliance resources to review your arrangements, in the sense that we're so comfortable with the level of risk that we don't think we need to ask you any questions about it, and you can take some comfort knowing that we're not going to knock on the door and ask you questions about that. The zones then escalate into the blue, yellow, amber, and red zone. And what that's designed to communicate is an escalating likelihood of the ATO applying compliance resources to review your arrangement. So red being the most high-risk zone, and what we're saying there is that, well, based on overall our experience and the way we've run cases before, that your arrangements are fairly high risk, and we would prioritize your arrangement for either a risk review or an audit, and our compliance resources will be dedicated corresponding to your level of risk. So the more points you score in this zone, the more likely it is for your arrangements to be reviewed. Now, there are 11 indicators in the document at the moment. If we wanted to make this a full 100% bulletproof type document around financing, we probably could have had 30 indicators in there. But there's probably 2 overriding considerations which we needed to have. The first and probably most important was burden upon taxpayers to, I suppose, collate data or run analyses or run ratios, and we didn't want to make it particularly difficult for a taxpayer to apply this document and understand what their scoring was. Right? So the indicators which we have selected, we think are fairly easily available to taxpayers and should be a minimal compliance burden to understand where your arrangements are. The second consideration is also from, and it probably segues nicely into our next slide, so if you move on to there. The second consideration is the ATO also needs to be able to monitor compliance with the document, and also needs to be able to know how we're going to apply our resources. And so the data or the considerations that go into each of these indicators, 95% of that data, the ATO either has or will collect in the future in order for us to be able to make decisions or accurate decisions as to where we apply our resources. So all of this information is either currently available to us through the tax return and the international dealing schedule of that tax return. In addition, once country-by-country reporting is implemented, that's coming in soon, and we have that sort of data sharing, we have a lot more transparency and information regarding global sort of financial structures and arrangements. We'll have a lot more information to be able to plug into our risk filters. If we don't have country-by-country reporting, we also have access to annual reports that get filed. They often contain a lot of information which is useful for us to run sort of our risk assessment against it. And thirdly, lastly, we also have access to third-party databases which contain financial information on most listed and even private companies globally. So it's relatively easy for us to be able to calculate global indicators such as leverage, interest coverage, average cost of debt for a particular group on a consolidated global basis. All of that feeds into what we call our risk filters. So the ATO and especially PGI have developed what we call risk filters, where we have algorithmic, I suppose, formulas and bases for running these filters across our population and having the filters report to us what the risk or the consequence of a particular breach of a risk are across our entire population. So we're becoming much more in tune with the use of available data that we have from your returns or from publicly available information, and we are converting that data into forms and media which we're able to use in order to make decisions on our, I suppose, on how we allocate our resources.
Shaz, we've got a few questions coming in. If I can, we might break there if you've got, if that's convenient time.
I was taking a pause there anyway, so it's good timing.
You mentioned the IDS on that slide. Two questions come out of that. Firstly, if you say, or what the first question is, if you've got a simple inbound loan, and in the IDS you say, well, it meets the simplified record keeping eligibility requirements. I turn to then paragraph 14 of the draft PCG. Do businesses with a very simple vanilla inbound loan, simplified record keeping, do they need to test that transaction within this framework?
No. So if you are already, and again, I think the simplified record keeping options and this PCG both give the same level of assurance in the sense that both documents seem to, or are designed to communicate arrangements where the ATO will not dedicate compliance resources. So if you are in compliance with the simplified options, that also feeds into our risk filters, and so we're able to have that sort of level of comfort that we won't be applying resources to it. So there's no need to double up in the sense that they both provide the same comfort level at the end. What the PCG does differently, I suppose, is it obviously broadens the simplified options to the entire population, and secondly, it communicates, or it's a bit more clear as to, well, if you are not within the simplified zone or the risk-free zone, what does that mean for me, or how far am I away from it, and what does that mean in terms of the ATO's reflex on whether they're going to review or audit me?
Yeah. Okay. In the reportable tax position schedule, businesses are required to self-assess their risk, but there's an option not to. If the business decides to say, well, I'm not going to self-assess, what ramifications will there be from the ATO side?
No, look, the reportable tax position, as you mentioned, there is it is voluntary. There will be a question about what zone you fall into in the PCG on the schedule. I suppose what I'm saying is there will be no direct ramifications, but I'm not sure it'll gain taxpayers that much, because 95% of the data, in order for us to make decisions on risk, is already available to us. What the RTP might do is the quality of data that taxpayers would have available to them to make comparative or to use against this PCG would probably be better or more accurate than the data we would have, because we would use sort of consolidated data as opposed to transactional data, which taxpayers would have. If anything, that would reduce, I would imagine, you self-assessing your risk would reduce the zones relative to what we would likely do on a consolidated basis. So I'm not sure it would actually be of benefit to taxpayers, but there's no direct ramification for not reporting on a voluntary schedule. So we will make our decision anyway, because we have most of the information at hand or available to us, and so there won't be anything which we'll directly do to those taxpayers. So you shouldn't worry too much about that.
Okay. And the last question goes to one of your 4 broad risk areas, being pricing, and the the first factor being the global cost of group cost of debt. In what situations will the ATO accept that the all-in cost of debt, group cost of debt, isn't really what the arm's length rate should be under Division 815 because, for example, a subsidiary might have a different credit profile.
Yep.
To the parent.
So there are a few points there. Firstly, that's a question which is not, and I want to be explicit that it's not really a PCG related, but I'll answer it anyway. Sorry, I'm been a bit sick and I'm losing my voice, so that's not directly on the PCG, but I'm happy to answer it. So it really depends on why the subsidiary has a different rating. Based on the ATO experience, if we have a look at the population of subsidiaries in Australia borrowing from debt markets, the evidence before us shows that most of the time the all-in cost of borrowing for an Australian subsidiary of a global multinational, if they access it from third-party markets, is not that much higher than what the group on average borrows anyway, which makes sense. I don't know why a group would allow significant leakages of interest outside of its group if it could get it at a cheaper source somewhere else. There are some exceptions where there are, for particular reasons, you have groups where the subsidiary does borrow off its own income sheet and balance, so income statement and balance sheet. They are normally sort of separately rated, or they issue debt themselves. If there is evidence that the subsidiary or subsidiaries of that group go to the market and borrow off their own balance sheets, then that's certainly something we look at. If they borrow off their own income, so that's something we look at. There are certain industries where that's more common than others. The global cost of debt is a general rule of thumb which we'll use for our risk assessment purposes. It's not an automatic for the question of is that arms and conditions. When someone says, well, my subsidiary or my taxpayer has a different credit rating profile to the rest of the group, the question I often ask is, well, are you determining that credit rating based on your actual conditions or arm's length conditions? So we have in-cap provisions in Australia which allow you to gear up to 60% of your asset base as a rough rule. That is unlikely to be arm's length conditions for most, and when you are geared up to 60%, your credit rating does plummet. The TP provisions, as they currently sort of stand, say that you determine the interest rate based on arm's length conditions, and then you apply that interest rate to your actual amount of debt. Now, your actual conditions may be very different to arm's length conditions, so you may not have 60% debt at an arm's length condition rate. So there's a few sort of questions to answer before we accept that, well, the credit rating of my subsidiary is different. The question is, well, why? Is it because of non-arm's length conditions, or is it because you're just taking what you have in front of you and pumping that into a Moody's risk calc or a ratings methodology, and then coming up with the BBB score? That's not what we're sort of looking at. Our first question is, well, what are the arm's length conditions that should feed into that sort of ratings methodology or ratings tool, and then let's see what the output is.
I think that the outcome really for me is that this, whilst this isn't a safe harbour, this isn't also something that is what the TP laws require, or you might be able to justify under the TP laws a higher rate, but it's for you to do so. This is all this is a risk compliance tool for
absolutely.
The ATO and taxpayers.
Yeah, exactly. This does not change the decision-making process of a taxpayer. If you believe that you can support a higher rate, that is absolutely up to you. All we're saying is that here are the likely ATO reflexes from that based on our assessment of risk. That still needs to be weighed up against, as I mentioned, it's just an input into your cost-benefit analysis as to, well, if I make a decision, I should know what the potential costs are, what the potential benefits are. We're just trying to help inform that decision.
Yeah. So let's say we're on red and we don't like being in red, and we want to go down to somewhere like green or white. You've given us some concessions here. Can you talk us through those?
Nice segue into the next slide. If we move on to the next slide, transitioning arrangements. So The first thing I want to say is that this document has been put together. When it's put together, I sort of acknowledge that for 99.9% of cases, most tax managers, financial controllers, whatever your position might be, if there was a related party financing instrument being put into your organization, I assume that in good faith, most of you would have said, look, I don't have the sophistication within the organization, or I don't have it within myself in order to be able to deal with that and price this arrangement properly. So in good faith, you most likely would have gone to your advisors, so either a big four firm or other advisor, and say, look, I need assistance with pricing my arrangements or coming up with a proper sort of structure for my financing. Now, the ATO hadn't published guidance for quite a while on financing, and so advisors themselves didn't have that much to go on. So in good faith, based on industry practice at the time, I'm sure most of them said, well, this is how we're doing things. We're going to price it based on this approach, and here is the rate that we recommend for your arrangements. Now, again, all of that was, I accept, was done in good faith. I think what the Chevron decision says is that approach may not have been appropriate or may need to be revisited. And I think if I did a straw poll, and I'd include myself in this, that 3 years ago or 4 years ago, if I asked every single person on this webinar, was the approach taken in Chevron consistent with the transfer pricing rules at the time, most of us probably would have said, yeah, well, that's how we do it, that's how industry does it, I don't see any particular problem with it, that seems pretty good to me. So all we're saying is that, look, in good faith, you went into this and the decision sort of says, well, you may need to reconsider. And so taking in all that into account, the PCG allows what we call an 18-month transition period, where for 18 months, if you engage with the ATO with the view of transitioning your arrangements into a lower risk zone, the commissioner will use his discretion with regards to penalties and interest to remit them down to as much of the discretion sort of allows. So again, we're saying, well, in good faith you went to do this. We don't expect that there was any profit shifting intention. It was all done based on what was industry practice at the time, but we want to transition those arrangements going forward into zones or arrangements where we consider it to be less risky. So we're not sort of after auditing you or hitting your arrangement with penalties and interest for however many years it goes back, but we do want to see going forward these arrangements into lower risk zones. So for 18 months, and what I'll say is the zone or the outcome on the back years and the go forward years doesn't have to be the same as far as I'm concerned. We can come to a resolution on the back years and then go forward if we have risk ratings or risk zones where we're both comfortable with, we can provide sort of sign off on the go forward arrangement as well, so that we're all comfortable and we all have certainty about financing arrangements going forward. So I'm not particularly interested in auditing everyone. I would rather sort of cooperative measures to deal with the issue and to get certainty going forward for both parties. And so that's what this 18-month transition period sort of envisages. There's also what we call a white zone.
Shaz, when does the 18 months start? Does it start from the date of the PCG? The draft?
It'll start from the date it gets finalised. So
Okay.
You'll probably have a few more weeks after that to deal with it.
Okay.
So there's also what we have, I mentioned there were 6 zones and I talked about 5 before. There's what we have also in there is the white zone. So one thing I recognize is this is a document which was designed to cater for a population. And when you design a document for a population, almost by necessity, there will be individuals within that population who may artificially be rated higher risk than their fundamentals of their arrangements would probably justify. If you engage with us and you explain why certain indicators aren't either appropriate or don't accurately reflect your risk, and we're comfortable with that, then we can agree to what's called a white zone, which is you're not in green zone based on the scoring sheet, but it gives you the same comfort level in that we will not dedicate resources to review it because we are comfortable with your risk. So that white zone is only available by engaging with the ATO, engaging with my team and explaining your arrangements and then coming to an agreement with us. So that is sort of another sort of mechanism to cater for the fact that, again, this document wasn't designed with individuals in mind, and therefore there may be a few areas which require reconsideration for particular individuals and particular circumstances.
In the PCG, I think there's a footnote on the white zone that seems to suggest that only reviews that occur after the date of the draft guidelines will be applicable for accessing the white zone. If you've had audits or APAs in the past that have risk rated you low, why wouldn't those, or why shouldn't those be considered as part of the white zone review?
So first with the APAs, we don't have financing APAs at the moment to my knowledge, and I would have thought most of them would have gone through me anyway, so that's not an issue. The audits one, the reason we didn't include it automatically is it really depends on when the sign-off was achieved. Obviously, the entire landscape of TP sort of changed for a couple of things. One, the Chevron decision. The second, there are new provisions which came into effect not that long ago, which even if you accepted that under Division 13, which was the old provision that they applied a particular way, there's a need to reconsider it from a particular point in time. So I'm not aware of many sign-offs on 815B in the sense that, well, we're probably only just starting our reviews at the moment, and there might have been some pre-lodgement compliance reviews, which is a more real-time product on certain taxpayers that have been going on during 815B years, but they certainly haven't concluded on a rating. So for the purpose of that law, we don't think there's actually a lot in those back years that we are now carving out. And I suppose that's the justification. If the analysis still holds up, I certainly, and one thing I'll show you, I certainly have no interest, and I certainly have enough arrangements on available to me to review. I have no interest in opening up old cases where likely that the outcome will be the same, but we can't give that assurance because most of those sign-up, almost all, I'd be willing to bet were based on Division 13, and the landscape has changed, I think, is the blunt response there.
Okay. If there's an arrangement, and this is a question coming from our audience today as well, if there's an arrangement that was paid out prior to year end, if let's say it's a 30 June entity, and it was in the red zone, will you be looking at these loans anyway? I presume so, because you've got, I presume you could, because TP has a 7-year under 815B review. But
and then
are you
unlimited?
Yeah. But I guess the question may be, well, are we really looking forward? The past is the past. We're looking in 815B land now. Chevron's changed the landscape a bit. How much would you be looking backwards if the arrangements are finished?
Really, yeah. So as an administrator, I'll probably have, it's not as easy as a normal business decision. And I'll be frank and sort of open here, is that we need to ensure that the debt or amount payable to the Commonwealth is appropriate on back years and go forward years. Now, my priority is the go forward years. That's what I want to ensure going forward, that we're right. That doesn't mean I'll give up the farm on the back years. And so that will go, what it will mean is how I allocate my resources between back years and go forward years, maybe slightly weighted towards go forward, but I'm not going to give up on back years just because people don't want to, like, there's no getting out of the arrangement. If you don't want to come and have a chat to us, I mean, we will eventually come and have a chat with you, just a sort of a matter of time. So I'm not going to give up the farm on the back years but it's also not going to be my focus. So there's no real safety there. I suppose the comfort is coming and having a chat to us and agreeing your arrangements or being in the green zone. It's hard for me to provide much comfort outside of that.
Sure. Okay. I don't know if I interrupted you too much on this slide or whether you want to move on.
Yeah, so we'll just quickly move on to some of the feedback and submissions. So we've seen some sort of three key themes coming, which is the first one being, well, a lot of our arrangements seem to be high risk or outside of the green zone. In response to that, I've been saying, well, we didn't release this document with our eyes closed. I think what we're saying and acknowledging is that, well, the model where, or the approach where most of the financing arrangements in the market today, the model that it was priced on post-Chevron probably isn't the right model. And I expect most taxpayers to be outside the green and sort of blue zones, or the lower risk zones. And when I did my population testing before releasing this document, 2/3 of taxpayers were outside of green. And that was fine because that's the reality of how far the previous approach and the current approach is. And I think we went in with eyes closed. I'll also say that my main focus isn't auditing, so that's not what I want to necessarily have to do. I'll do it if I have to, and I'm pretty good at it. But what I want to say is that if you are outside of green, or if you're not low risk, I want to let you know that that's what the reality is. That's how far we probably see potential your arrangements versus what we see as low risk. And there's a real risk that we're going to come and knock on your arrangements. If you want a lower risk arrangement, then we're available to sort of come and sort of deal with that. Second sort of key theme is consistency with Chevron decision. And so there are a few points where say, well, why is this? Why are some of these indicators in there? Because they don't sort of go to pricing. That's all you can do. Again, this is a risk assessment document. It's not an interpretive. It's not a safe harbor type document where we say here is a rate and that's what you need to apply. Risk is based on the Commission's sort of experiences, analysis. It's all sort of backed up based on empirical evidence that these seem to be the key sort of drivers of risk in all of our financing cases that we reviewed and have been successful in going forward. Risk itself doesn't have to be, I suppose, easily compartmentalized into particular words or provisions. The way we see risk is broader than just what 815, 125 might say, and other things such as behavioral indicators or attitudes of taxpayers also feeds into risk. And I think the ATO broadly has been quite consistent with that. That's how we, our risk differentiating framework, all of that sort of also brought in risk or behavioral elements. Even the old, if you're also 9811, if you go through the documentation ruling, had a weighting for likelihood of, or the behavioral sort of reflex. So that's that. And so that's the sort of those two things sort of combine, relevance sort of indicators and Chevron decision. It's a risk document. I think it's important to remember that in assessing each of the indicators. Potential changes, there are a number that I foresee. There are probably only a few that I'm probably confident enough will be go through our review process to talk about at the moment. First one being the definition of price. So we've got three sort of indicators. We're probably going to put a hierarchy in relation to the pricing. So put a bit of a hierarchy as to which one you go to first and second and third, and maybe change some definitions as to how you calculate cost of debt, etc. The leverage of borrower at the moment, the denominator is, so how you calculate leverage is debt over debt plus equity. That's how credit rating agencies measure leverage. That gives strange reflexes when you have sort of non-equity items such as retained earnings and other things. And so we're probably going to change the leverage to be more consistent with ThinkCap, so it'll probably go over an asset base.
Yep.
So that's that's a change which I think may impact quite a number of taxpayers. The interest coverage ratio. Sorry, Jerome.
No, keep going. Okay.
Interest coverage ratio may change, so some of the numbers there may move here or there. Another thing is there is a particular paragraph, so paragraph 104. The intention of that paragraph was that for certain indicators such as appropriate collateral, subordination, presence of exotic features, etc., where you haven't added a premium onto your pricing point to reflect the presence or lack thereof of these particular indicators, the intention of para 104 is to say, well, if you're not pricing based on higher risk, then don't give yourself any points in relation to it. I think we're just going to clarify that and have something similar against each indicator where it's relevant. So we will be more explicit that, for example, if your loan is legally subordinated but you've priced it based on a senior debt, now I don't want you to give yourself 3 points for subordination when you priced it based on it not being right. So I'd rather you give yourself 0 points for that. So that's the intention. That's how it's probably going to change. They're the ones I'm comfortable talking about. There are a few other things which are under pipelines, and so we are going through the process of. In fact, this afternoon I'm catching up with my team to go through the last bits of feedback or last submissions that we received in relation to the PCG, and we'll go through the process of agreeing any sort of changes that we have this afternoon within my team, and then we'll discuss that with our with the higher ups to just get them comfortable with those changes, and then incorporate it and hopefully finalise it soon after.
The clients that we've been talking to, I guess, looking at the relevance of the indicators, it seems to be that there are a number of indicators that are marked quite highly, and it seems that the risk ratings are trying to push people into the red zone. I appreciate you've said I think only a third of the population is probably outside of green in your population test.
I think only a third was in green. So. Oh,
in green, 2/3 are out.
Yeah. Correct.
I mean, things like hybrids being 15, that automatically kicks you, halfway into the zone.
We will. One thing with the hybrid is that we will have. So the definition will say that once the hybrid rules kick in, that indicator effectively drops off. So it's more of I think it's more of an interim issue rather than a long-term issue with the hybrids. The hybrid is something which I suppose our government has said is a risk and want to stamp it out. I think we've put in legislation to OECD and other sort of administrators have equally attacked it. So I think it's something which not just the ATO but globally administrators see a lot of risk in it, and I think that's how we've sort of reflected it.
Yeah, and the other bit of feedback I've been getting from my clients is on the currency point. Foreign currency seems to be something that the PCG is looking at very carefully, and it seems like you can be attacked 3 times in the risk indicators for the same transaction and for the same underlying reason.
So one of them would be in the exotic features. Now, if you haven't priced in anything for that foreign currency, then that should drop away. Yep. The currency being different operating currency, and I think the other one would be the taxpayer alert. Now, that may be double counted, but only in rare circumstances will you have that double counting. The actual underlying risks of the two are very different. So currency of debt being different to operating currency is one which is creating artificial FX gains or losses or artificial exposures relative to the business. The taxpayer alert is really about synthesizing arrangements using 2 separate instruments, if I sort of simplify it that way. They're really looking at different risks. So if they happen to get marked twice, it's not like we're going to audit you twice. With those scores, you're likely to be fairly highly rated anyway. So And again, those are the type of things where if you are double hit, then maybe that's something you can come in and discuss with us, and we can alleviate, or we can allow 10 points to not be double those have to be double counted.
Yeah. Out of interest, how many submissions, if you can say, did you receive?
We received quite a few. So I think it was around the 20 odd mark. So I try to get final numbers, but my sort of staff member was sort of coordinating. It was away sick last couple of days, so I think it was around the 20 odd mark. So that's not including sort of minor submission comments, sort of email sort of sent through saying, what about this, that. If we included that, it would probably get up to over 100. So it's been a fairly active point of discussion for the market.
And when are we expected to see a final ruling, do you think? A final, sorry, not ruling, a PCG.
Yeah. Look, hopefully, I'm hoping if everything goes well with the reviews and approvals, I'm hoping sometime mid-August. Now, the ATO is an interesting beast when it comes to getting stuff out quickly, but that's my hope.
And the schedules that you talked about at the start of the call, do you have an indication of when they may be released for consultation or otherwise?
Yeah, derivatives, guarantee fee, so derivatives and interest-free loans and guarantee fees sometime this year will go out for consultation and draft. Other debt test most likely sort of first half of next year. That's a bit of a longer process.
Yeah, okay.
There's a few things on my plate to get out, so I need to get this document finalized first before I can release those other schedules in draft.
Well, I think we've exhausted the time today. We've exhausted the questions from our audience as well, so thank you very much. I might hand back, or we might, unless you've got any closing comments, Shaz, we might hand back to Walters Kluwer today.
No, just thank you everyone for attending. I appreciate it over most people's lunchtime, so hopefully you found that useful. Again, if you have any questions, there is an email at the bottom of the PCG with my sort of team's email address. Feel free to email us with any questions. If you want to engage with us to discuss how to change things, we're always happy to have those discussions. So thank you, everyone.
Yeah. As are we at Mallison's as well. Just a little plug there.
Thank you to Shaz and Jerome for today's presentation, and thank you to everyone who attended today. If you didn't get a chance to answer all of your questions, we'll make sure to follow up via email. And there is a quick survey at the end. If you can participate in that, would be great. To all of you, have a great day. Thank you.
Thank you.
Thank you.